Hi, good evening. Today we'll discuss employee loan at below market rate of interest, that is Ind AS 109. To start with, we'll first discuss the concept. So, financial assets can be measured at amortized cost, FET OCI, or FET PNL. Now, the initial measurement in all the three cases would be at fair value. That is, for amortized cost, the initial measurement would be at fair value. For FET OCI, that is fair value through OCI, would be fair value, and for FET PNL would be fair value. The subsequent measurement for all the three categories would be for amortized cost, it will be at amortized cost, and for fair value through OCI and fair value through PNL, it will be at fair value. Now the transaction costs have to be added to amortized cost and FET OCI and charged to PNL in case of FET PNL. This is the concept of financial assets for computing the accounting for the same. Now we'll discuss an elaborate example to discuss how this fair value would be taken into consideration. A company gives a loan to employee at 5% of an amount for an amount of rupees 20 lakhs. The market rate of interest is 10% and 1/5 of the loan is repayable at the end of the year. So first we'll do the computation as to what will be the inflows, what will be the outflows, and how the interest computation would take place. So to start with, the loan is for 20 lakhs. 20 lakhs is the loan amount. Repayment is 1/5 at the end of each year. That is 1/5 of 20 lakhs is 4 lakhs. So 4 lakhs would be the repayment amount at the end of each year. Now interest at the rate of 5%. Since the repayment is happening at the end of the year, so interest would be computed on the initial loan value of 20 lakhs. That will be 5% of that will be 1 lakh. So the total inflow from the employee to the company would be 4 lakh repayment plus 1 lakh interest. That will be 5 lakhs. In the second year, 20 lakhs minus 4 lakhs, 16 lakhs would be the closing balance, which will be the opening balance for the second year. 16 lakhs, 5% of that would be 80,000 and 4 lakhs would be the repayment amount. So the total outflow would be 4 lakh plus 80,000, that will be 4 lakh 80,000. In the third year, 16 lakhs minus 4 lakhs, 12 lakhs would be the opening balance. 12 lakhs, 5% would be 60,000. So 4 lakh would be the repayment amount. 4 lakh plus 60,000 would be the total inflow. 4 lakh 60,000 would be the total inflow. And the opening balance for fourth year would be 8 lakhs. 8 lakhs, 5% of that would be 40,000. 4 lakh plus 40,000 would be the 4 lakh 40,000 would be the total inflow. And closing balance would be 4 lakhs, which will be the opening balance for the fifth year. 4 lakhs, 5% of that would be 20,000. 4 lakh 20,000 would be the total inflow and the closing balance would be 0. So the total of interest at 5% would be amounting to rupees 3 lakhs and total of interest inflow would be 23 lakhs. Now we'll compute the inflow, which is 5 lakh, 4 lakh 80,000, 4 lakh 60,000, 4 lakh 40,000 and 4 lakh 20,000. Now we'll compute the present value of these inflows. So the present value of this inflow, 5 lakh into present value factor. The market rate of interest is 10%. So 1 divided by 1.10 raised to the power of 1 would be 0.909. So 5 lakh into 0.909, 454545 would be the present value for the first year. For the second year, 4 lakh 80,000 into 1 divided by 1.10 raised to the power of 2. that will be 0.826. 396694 would be the present value for the second year. 4,60,000 into 1 divided by 1.10 raised to the power of 3 would be the present value factor for third year. That will be 0.751. 4,60,000 into 0.751 would be 345,604 would be the present value for the year 3. For the year 4, 4,40,000 into 1 divided by 1.10 raised to the power of 4, that will be 0.683. 4,40,000 into 0.683, 3,00525 would be the present value for the year 4. And for the year 5, 4,20,000 into 1 divided by 1.10 raised to the power of 5, 260,786 would be the present value, and the total of these present values would be 175,8157. Now present value of the loan is 175,8157. 10% at market rate of interest would be 175,815. Inflow would be 5 lakh. So 175,8157 plus 175,815 minus 5 lakhs would be 1,433,973. This will be the opening balance for the year 2. 1,433,973 minus 4,80,000 and 1 into 1,433,973 into 10% would be 1,433,97. 1,433,973 plus 1,433,97 minus 4,80,000 would be 1,097,370. For the year 3, 1,097,370 into 10%, 1,097,37 less inflow 4,60,000, 747,107 would be the opening balance for the year 4. Now 747,107 into 10% would be 747,110. 747,107 plus 747,110 minus 4,40,000 would be 381,818, which will be the opening balance for the year 5. 381,818, 10% of that would be 381,811. So we'll add 381,818 to 381,811 less 4,20,000 would be 0. So the total interest at 10% would be 541,842. In the P&L, the credit of the interest at 10% would be 541,842 and debit of the interest would be 3 lakhs. So in the P&L 241,843 would be charged. So this 241,843 plus present value of the loan 175,8157, the total amount of loan 20 lakhs would be there. Now we'll discuss the scheme of entries. So 175,8157 is the present value of the loan. So employee loan account debit would be 175,8157. To bank would be 20 lakh and the differential of the two would go to prepaid employee expense account. That will be 241,843, which is the amount in the credit of the P&L. So 241,843 would be the prepaid employee expense account. Now prepaid employee expense account would be amortized over 5-year period at the same value. So this P&L, the accounting entry for the same would be P&L account debit to prepaid employee expense for each of the 5 years with 48368 in each of the 5 years. Now the credit of the credit to the P&L would be employee debit would be to employee loan account and credit would be to interest income with 10% of the interest income. So these figures 175,815 would be the amount to be credited at the end of first year. So employee loan account debit 175,815 to interest income 175,815. In the year 2, the 10% interest amount is 1,433,97. So in the year 2, the employee loan account would be debited 1,433,97 to interest income account 1,433,97. In the year 3, 109737 is the interest income. So employee loan account would be debited with employee 109737 and to interest income 109737. In the year 4, 74710 would be the interest income. So employee loan account debit 74710 to interest income 74710. In the year 5, 38181 would be the interest income. So employee loan account debit 38181 to interest income 38181. Now there would be repayment by the employee at the end of each year. So the repayment amount which we discussed was 5 lakhs, 480, 460, 440, 420. So the repayment would be as follows: bank account debit to employee loan account 5 lakhs, bank account debit 4,80,000 to employee loan account 4,80,000, bank account debit 4,60,000 to employee loan account 4,60,000, bank account debit 4,40,000 to employee loan account 4,40,000, bank account debit 4,20,000 to employee loan account 4,20,000. Now we'll see the balance in the employee loan account. Opening balance was 1758157. The total of 5-year interest at 10% was 541842, and the payment to the employee loan account was 23 lakhs, which is these payments. So the total of employee loan is balanced: 23 lakhs in the debit, 23 lakhs in the credit. This gives a closing balance of 0. Now we'll see the charge to the P&L. Prepaid employee cost is 48368, which is same over the period of 5 years. Prepaid employee cost debit to the P&L would be 48368, 48368, 48368, 48368, 48368 for each of the 5 years. And the credit of interest income at 10% would be 175815, 143397, 109737, 74710, 38181. This would be the interest income for each of the 5 years. The total of these, the difference between the two would be 3 lakhs, which is the difference 3 lakhs, which is the difference between 20 lakhs and 23 lakhs with loan amount. This brings us to the end of the session. Please do like, subscribe the channel. Thank you so much.